Hi, and welcome to Crypto for Advisors, a podcast by Synergist. More than a third of Australians are into crypto, yet nearly 90% of advisors will not discuss it with them. I believe this is exposing investors to unnecessary risks, compromising the value of advised relationships, and limiting investment performance. My goal is to educate advisors and investors to bridge this crypto service gap while strengthening advised relationships. So let's get into today's episode. Welcome to Crypto for Advisors. Today I'm joined by Toby Potter, founder of IMAP, the Institute of Managed Account Professionals. Toby has been at the forefront of shaping Australia's managed account industry, helping advisors and licensees understand how new structures can add value to their clients. He brings decades of experience, a deep understanding of the advice profession, and an ability to translate complex industry change into practical outcomes. While he's the first to admit that he's new to the world of digital assets, Toby's perspective as a trusted industry leader makes him the perfect guest to explore what advisors should be thinking about as crypto, stablecoins, and blockchain technology starts intersecting with mainstream advice. So, Toby, welcome and thanks for joining me.
Thanks very much, Andrew. It's a pleasure to have the opportunity to learn something about the digital world.
Fantastic. So, Toby, we're going to go through three topics today. Firstly, digital assets as an asset class. Second, stablecoins and their potential. And then third, blockchain as infrastructure for the advice industry. But I thought perhaps we can start by discussing the current sentiment of advisors and licensees towards cryptocurrency. What conversations are you hearing?
Look, to be honest, Andrew, both in my IMAP life and in my other life at Philo Capital as an MDA provider, when I deal with advisors, I've got to say that the thoughts that they bring to crypto, digital, probably pretty mixed. The managed account world has become very much a world driven by investment consultants or portfolio managers. And you know, the truth is that for them, in many cases, building diversified portfolios out of the mainstream asset classes, moving into private markets is much more the focus than looking for what they would regard as speculative and somewhat unimproved asset classes such as crypto.
So it presents a bit of a challenge, doesn't it, when I guess the gatekeepers to product selection through advised relationships don't see it, I guess the need or the appeal to engage with digital assets as an asset class. It makes it quite challenging for it to get onto approved lists so that advisors can actually discuss it, doesn't it?
Yes, it certainly does. I think in some ways it reminds me somewhat of the move to ESG investing perhaps 5, 6, 7 years ago. It's likely to be an investing area driven more by clients ahead of the advisor and certainly clients ahead of the portfolio manager than it is driven by advisors saying this is a clear place for this in portfolio. So we might talk a little more about that, but I can think of quite a number of roadblocks in the way of incorporating this asset class in particular into portfolios which are expected to be aligned with client goals, client objectives.
When you break it down and say that the objective is to align it to client goals and their objectives, I guess it's, when you look at the current adoption rate of crypto globally and indeed in Australia, it's already quite high. So clearly the market from, as you say, a bottom-up point of view has already embraced crypto as an asset class and decided that it is a legitimate asset class. When do you think the asset consultants or licensees, when do you think that they will adjust their thinking, or do you think that they won't?
Portfolio managers, whether they're advisors or investment committees of licensees or the mainstream independent consultants, turning around and saying, look, when I model the outcomes expected from a portfolio, a particular combination of assets, I want to know the expected return, the expected risk behavior in the sort of left tail circumstance and the sort of correlation between this asset class and other asset classes. And that's going to give me a position on the efficient frontier.
Hmm. Hmm.
And so in a sense, the struggle for crypto assets is that, as I see it, is that the history that a portfolio manager, even a well-inclined portfolio manager, might be able to look to um, in using the standard portfolio construction methodologies, 20 to 70 year history just isn't there. So we know that Bitcoin's gone through one market crash, but there are a lot of digital assets that aren't Bitcoin, as I understand it. And so, in a sense, the complexity of an emerging asset class makes the problem of a portfolio manager even greater. When I think about Australian equities or Australian small caps or
Mm.
Australian resources stocks or Australian banks or any other definable asset class, I've got a history that I can turn to as a portfolio manager to say, well, this is the history of the performance of small caps or resources stocks or banks or the All Ords or industrials ex mining or emerging markets ex China. I've got a history that I can look at and go, well, this is how I think this particular asset class might perform in this particular market. That's missing for even the longest established digital assets, let alone the Donalds.
Trump coin, everyone's favorite.
So, um, so I guess that's sort of leads me on to the other challenge, which I'm sure that they have, which is there isn't a single asset class. There is Bitcoin, there is Ethereum. That's the one my son invests in, I think.
He'll be happy right now.
Well, I hope so. Yeah. He's also an investor in one of those defense ETFs. So I think he's doubly happy. But, there is just a big range of emerging asset classes as entrepreneurs bring investment opportunities to market. So these are the sorts of challenges that a portfolio manager trying to build a managed account faces into.
It's an interesting challenge because you're right. We don't have the longitudinal data set available for crypto, and even if we just focus on Bitcoin for now, it's only 16 years old or something now. So we don't have the 20 to 70 year data frame to be able to look at all the modeling through all the different economic cycles and see how it performs in different environments relative to other asset classes. And that's the conventional approach. But at the same time, we are seeing the volatility of Bitcoin smooth out considerably as you're seeing substantial institutional flows come in via ETFs, as you start seeing corporate treasuries start holding Bitcoin on their balance sheets, as you start seeing more sovereign funds investing, and you're diversifying out the investor base of Bitcoin into holders who will invest for the long term or hold for the long term, which smooths out that volatility quite a bit. The other frame to look at it through is to say, well, Bitcoin alone has a market capitalization greater than the combined sum of all listed Australian companies. So to discount it because it doesn't have the longitudinal data seems like it's kind of missing the bigger point.
That's one perspective,
Hmm.
I guess, and I'm completely uninformed in this market, Andrew. And so, as I said, I came on this podcast to learn, not to orate. But a cynic would say, look, I don't know what the market capitalization of tulip bulbs was
The
in Amsterdam
1600s.
in the 1600s, but that probably got to something equivalent to the one that sticks in my mind is Japanese property, where at one point the Royal Palace in Tokyo, the land area of the Royal Palace in Tokyo was worth more than California based on land value of the major commercial areas in Tokyo. So we do see asset classes that reach ludicrous heights. We may be living through such a thing at the moment with Nvidia and Tesla and the Magnificent Seven.
Mm.
So at the end of the day, there's got to be an underpinning fundamental structure. Now, I was listening to a podcast recently myself where the argument was put that, gee, The fundamental underlying underpinning of digital assets is they are the currency of the criminals, that the governmental systems have lost control of Bitcoin and stablecoin. And if you're in the business of importing or exporting drugs, or this week's article in The Economist on the UK as the source of more stolen cars than anywhere else in Europe, you've got to have a way of avoiding the US-dominated banking system. And stablecoin is that way. So
Well, I think,
it may be that there is a genuine economic argument in favor of digital assets. And it's
well, there's a lot of misconceptions around cryptocurrency, and that's one of the most common ones, is that crypto's full of criminals and scams. And I think it's anchored in all the way back in the Silk Road days, when that was the first use case for Bitcoin, was a marketplace where you could buy and sell anything that wasn't regulated by governments. And it was supposed to be all libertarian driven and equitable and nice, but it ended up, obviously being proliferated with drugs and hitmen and all these other nefarious sort of purchases, and that was the case. But we're in a very different scenario now, in that crypto is actually the worst asset class for criminals to transact in, because it's completely traceable. Bitcoin is a public ledger that is immutable, that's transparent, that anybody can see the transactions. And people think it's anonymous, but it's not actually anonymous, it's synonymous, which means we don't know what your wallet necessarily is, but we do know what wallets are transacting and who and by how much. And I certainly, from the ATOs, if you look at it through an ATO lens, I can guarantee that the ATO, you can see it in tax returns already. They will notify the advisor and say, your client has got cryptocurrency. We know that they're holding crypto. Make sure you declare it. So they've mapped all the addresses to people already. And so using crypto as a payment service, it's 100 times worse than using, say, cash, which is completely untraceable.
yeah, look, absolutely. I mean, that is the counter argument that I think I forget whether it's 40% or 60% of all currency, US currency on issue, is issued in US $100 bills, and they just do not circulate in the US. They are the original currency of the criminal class. So let me turn the question back to you, Andrew, there, which is, okay, so I'm constructing a portfolio for somebody in accumulation, the typical, 52-year-old husband and wife, or male and male partner, whatever it might be, with a, retirement goal in another 13 years sort of thing. What is the part that which digital assets and what part should they play in that portfolio?
Okay, well, not financial advice, all right? We just put
Not
that right.
financial.
I don't need a knock on the door from ASIC. But, well, look, I mean, you need to obviously apply the normal approaches that you would as an advisor giving general advice. The way I would approach it is, I'd say that it's appropriate to treat crypto as a speculative asset class, which is the higher risk portion of your portfolio. So depending upon your ideal allocation, you might, in that scenario, if they're quite progressive, then it might be appropriate that they have 5% of their portfolio in the more speculative type asset classes looking for growth. And so if that's the case, it depends. Then I'd be talking to them about, obviously, the things you mentioned, like investment horizon, but also, what vehicle they're holding it in as well would be important. So if it's in their super, for example, personally, I think that most of the time the super, you would just be wanting to hold in Bitcoin, as a long-term store of value, because that's the use case for Bitcoin. Really, it has other things, but the primary use case for Bitcoin is a long-term store of value, in my view. I think potentially you could go into other layer one infrastructure protocols like Ethereum, you mentioned earlier, and there might be one or two others, but I'd probably be leaving it at that for that type of investor. If they're a younger investor and they had a lot more time and they wanted to engage and they had an interest in this area and they wanted to educate themselves, then you could probably put more than that allocation in, and probably, as long as they had good quality, independent research to help that guide them around what the value cases behind some of these altcoins are, then perhaps they could start going into that. But altcoins are hugely volatile. There's some amazing opportunities in there, and that's why they grow so rapidly. But they also drop so rapidly because a lot of it is unproven, and there's not that much liquidity in the market, and it gets spooked quite easily. It's still seen as a risk-on asset, and so it'll get impacted by macroeconomic factors and geopolitical factors quite strongly. What I would ultimately do, though, is I'll come back, and you made a point earlier around you need to understand the value. So, the property prices of the Royal Palace in Tokyo, or the tulips, and you need to say, well, what's underpinning the value of this? And I think if you look at crypto, what's underpinning the value of most of it is blockchain technology, distributed ledger technology, which is revolutionizing entire industries as we speak. And so there's a lot of businesses that will come into that space leveraging blockchain or distributed ledgers, and take on the incumbents and offer a much faster, a much cheaper, experience to consumers. So, some of them will win, and win well. So, but you need to know, and you need to have a foundation to be able to make that judgment. And you're not going to get that foundation through the traditional means that you would for Australian equities or US equities. As you say, there's no asset consultants or established research houses doing this. It's influencers. And if you're lucky, you find a good crypto broker or a good crypto exchange that has some analysts on board that actually, are applying a decent amount of rigor to their articles and their content.
So are we investing? So if we're thinking about a couple of questions come up. Let me start off with what it replaces in the portfolio. So if I hear you correctly, this is a speculative investment. So we're putting it into the growth alts part of the portfolio. And now, because I'm right in thinking that none of these digital assets have any income stream associated with them. The value, that's my perception. So the value is predicated solely on the expectation that it'll be worth more next year than it is this year.
No, that's not.
Like Sydney house prices, by the way.
Yeah, no, I was going to say some derogatory comments about my children and my family life. But
Of course, your kids will be worth more next year. You'll be able to. There'll be an open
not
market.
getting too much right at the moment, but I'm banking on the future appreciation of value. But no, to be serious, I guess how. So are they income producing? Yes, some of them are income producing, and we're about to see a significant shift in the market. So in the US, under Trump, he has focused the regulators on going from being antagonistic towards cryptocurrency to positioning the US as the global leaders of cryptocurrency.
This is the Genius Act.
Well, the Genius that's the Stablecoin Act, but I was thinking more about the Clarity Act. So the Clarity Act is the act that provides certainty to financial institutions and companies who want to participate in crypto. So it will categorize different types of tokens as different types of instruments, and give clarity around how they will be treated from, for example, from a tax point of view or from a licensing perspective. And so that's critical, because without that clarity, institutions can't participate in that asset class. But once that clarity is delivered, and it's passed the House, it's in the Senate for debate, and it's probably weeks rather than months away from being signed into law by Trump.
Not such a snappy acronym. So
I quite like it. But when that comes in, I expect to see a proliferation of retail financial services products targeting the US consumer market, because, for example, banks will be allowed to custody Bitcoin and crypto. So like they'll hold your money, they'll be able to hold your Bitcoin. That means that they'll be able to then use it as collateral for lending. So you'll be able to stake your Bitcoin and earn income off it, much like you would put a term deposit in and earn a return on that term deposit. There's more sophisticated products will start coming out around crypto-backed loans, for example. And so these things they exist today, but they exist on the fringes, and in Australia, there's a company called Block Earner. I don't know if you've come across them, but ASIC sued them. They've been in court for years with ASIC. They were offering crypto-backed lending, and ASIC took them to court. It was in the court for years. A month ago, ASIC lost, and they ruled in favor of Block Earner. Block Earner are now out in the market. In fact, just this week, they've raised, I think it was 8 million to be able to take their products to market. And that's crypto-backed lending in Australia. So it's just starting to emerge, and so these ways where you can actually use your crypto like you might use other assets to earn income. Some of the tokens will have built-in income in them as well. For example, for a lot of altcoins, you'll look at what the tokenomics are and look for things like X amount of the revenue that the business generates comes back into buying back tokens. So you've got the burn rate built into it, and that drives the price of the assets up. So it might not be an income into you as a return, but it's a virtuous cycle which is growing your price. So there is a fair bit of sophistication out there, and it does make it challenging because one size doesn't fit all, and you really need to understand the mechanics of some of these tokens to be able to make an informed decision about how
Look,
good an
I can
investment it is.
certainly see, if I understand stable coins correctly, which
Mm.
is a US or presumably euro or yuan back digital asset, where there's a one-for-one backing between the treasury bills or the equivalent and the issued stablecoin. I can see a real place for holding that as both potentially for income because the underlyings have a yield or the backing asset, the backing currency has a yield, and I'm sure that'll be split between the investor and the issuer. And I can see a stablecoin being a wonderful way of holding a portfolio of assets completely unhedged and managing the hedging through buying and selling a US dollar or basket of currency stablecoin. I can see that working every day at a retail level in the way that and providing currency hedging in a way that derivatives simply have not been able to do in a retail and wholesale investor market way.
Mm-hmm.
So I can easily see somebody going, I can easily see a portfolio manager saying, we only buy unhedged assets and then we manage the hedging exposure and we use stablecoin to do that.
Yeah, that is one use case that you could use stablecoins for. It is. I think stablecoins have grown exponentially, and it's off a different use case, and that's basically global payment rails. And again, this is another example of how crypto has grown from the grassroots. So if you think about moving money around the world, if you're moving a large sum of money from one side of the world to the other, there's teams of lawyers involved. There's huge fees. It takes weeks to
Yep.
transfer it through.
Well, and if you do it through, if you're a retail investor and you do it through your bank, you will get, it should be called scalp coin.
Absolutely. So with stable coins, instead, what you can transfer it instantly for almost nothing. The fees on transferring it is counted in dollars or tens of dollars, and it's done it instantly. And there's no intermediaries. It's just I just need to know the address, and it's done. And so stable coins in the last few months, they have overtaken the combined volume of transactions of Visa and MasterCard. So there's more value of stable coins being transacted now than MasterCard and Visa settlements, global settlements combined. And even the greatest crypto cynic of all time, Jamie Dimon from JP Morgan. So he came out. He would love the comments about the Japanese palaces and the tulip phase of the 1600s, because he came out with the famous quote of calling Bitcoin a pet rock in 2018, and saying that any trader in his company caught trading in crypto, he would sack them on the spot. Well, JP Morgan have their own stable coin, JPM coin, which they have had for over 12 months. And not only that, but JP Morgan now allow their customers to hold crypto on their platforms, and they actually allow their customers to use Bitcoin as collateral for their lending. So even the greatest Bitcoin skeptic of all time has done a 180-degree turn and gone, the market's decided I need to adapt or else I'm going to get undercut.
Yeah. I look, the other thing which I'd be really interested to learn a bit more about,
Mm,
Andrew, is sort of distributed ledger technology or blockchain,
mm.
in its other, in its other sort of incarnations. How you see that playing out in, the world I live in, which is sort of the managed account platform world. I mean, the ASX has had a near-death experience from its venture into DLT, as I understand it from what you read in the paper. So where do you see that playing a part in this sort of retail investment portfolio?
Yeah, great question, and one that I was actually hoping to ask you. But as a seasoned interviewer, you've managed to switch it beautifully. Look, it's probably I have a view of it. I wouldn't say I have that well an informed view, but my understanding is, yeah, if you look at the ASX, they did have an almost near death experience in trying to introduce a blockchain solution, and it didn't work. They had to back it out, and it was bad. But if you look at what's happening now, I think about things like Project Acacia. Have you heard of Project Acacia?
No, no.
So, Project Acacia is a project which is sponsored by the RBA, and it's run by the Digital Finance CRC. And they've just selected their main technology blockchain provider, which is Red Belly, which is an Australian blockchain, a really good Australian blockchain. And so they're building out an Australian CBDC, which is centralized bank digital currency, but it's not a retail CBDC, it's a wholesale CBDC. So all of the interbank settlements that happen, that are the lifeblood of the whole monetary system and fiscal system in Australia, interbank transfers, all of that is transferring across into distributed ledger technology, into this blockchain solution. And so that's happening right now. And that project, it's been funded by the government. They've selected their blockchain provider. They're developing it right now, and it's an all Australian solution, which is actually, I was reading up about it today, and it looks like it's actually going to be world leading in its capabilities, how they're spec'd it out, like from a security protocols and privacy and protocols. So that's a good example of how this technology is being embraced even by institutions, by companies, where there's a number of use cases that really present. And one is, real world assets, and that's the digitalization of everything from real estate to artwork to equities. I still think that's a little way away. They do exist, like Robinhood, for example, has digitalized tokenized equities on the blockchain. But there's arguments for it in that you're giving access to buying US stocks to people in Africa that would otherwise never be able to open up a US trading account and pay all the fees and everything like that. But really, it's not the same as the stocks. There's a few but it's a step down that path. But there is that. And Larry Fink, the CEO of BlackRock, has said in December last year, he came out and said that in 10 years' time, all BlackRock's assets will be digitalized. And that's like 11 trillion will be digitalized. So it's transforming industries. It will happen. How quickly it's happening, when it's going to really get traction, we're still waiting for it to take off. But it's one of these things where I think it's going to be bubbling away, and then like stable coins suddenly just take over.
Yeah, I can see that. I mean, when I think about when I try to draw up people typically call it a value chain, but if you but you can reverse that and try and build up a cost chain for a retail investor to invest in a diversified portfolio of assets. Once you put the costs of transactions, pooling and unitization,
Custody.
platform administration and custody, I don't know if you get to 100 basis points, even if the investment managers keep their share of the cake. But if you just take out the strict admin costs, you're at north of 50 basis points for
Easily,
a
yeah.
investor, and you're probably giving a good nudge to 70 basis points.
Yep.
And so the potential for distributed ledger technology to turn that into single digit basis points seems to me to be probably, I mean, there's probably plenty of pioneers out there right now going, I can do this.
Yeah.
And it'll
And
be
what's
a decade.
stopping them is legislation, because what you've described, that is what's happening in other jurisdictions, like in the UAE and in Singapore to an extent, even in the UK to an extent. And there's a lot of people sitting in the background at the starter's block, just waiting for ASIC to fire the starter's gun with a bit of regulatory certainty, so that they can actually commit to it and start putting these things into the market. But it's very hard to do that, when you don't have that regulatory certainty.
Well, I wish them all the best. I've been working in managed accounts for 23 years this year,
Wow.
and
Since their inception.
well, exactly. And one day I'll get rich.
Well, you need to load up with some Bitcoin. I'll send you a link. Or speak to your son.
Oh, yes, exactly. Yes, exactly. He's about to venture into that most speculative of all asset classes, Sydney house
Marriage?
price. No, wow. Yes. No, he might be listening to this.
I'll edit that part out. Yeah, no, fantastic. Well, thank you, Toby. I really appreciate your time. I know you've got a big event on in a couple of days, so I know it has an opportunity cost, but really enjoyed our chat, and hopefully we can catch up and continue the conversation and support the managed account industry to adapt to this new asset class and embrace it at some point.
Great. Look, thank you very much, Andrew. It's been interesting and enlightening for me. Yeah. I think it's something that's going to come in a managed account near you. Yeah.
This podcast is for informational purposes only and does not constitute financial advice. All views of Andrew McPhee and his guests are their opinions only and do not reflect the opinions of Synergist. You should not treat any opinions expressed as a specific inducement to make a particular investment or follow a particular strategy.